Hi traders, and welcome to this week's edition of the Keyzone Traders Trade of the Week. This week we're going to look at a trade that we took on the DAX yesterday in Thursday's session, and what we're going to do is we're going to look at how we can manage a trade when we're against the strong trend in the execution time frame, but the higher time frame context is supportive of the trade idea. So I hope you find this useful. Let's go take a look. Hi traders, and welcome to this week's Trade of the Week. As I say, slightly different thing today. We are going to look, it's a very similar setup to what we normally look at just because that's our style of trading, but I just want to show you how we can manage trades as well when we're against the short-term order flow in the market. So this was in yesterday's session. We opened up and we created a slightly new all-time high here. We've been talking in our reports every day about the DAX making new all-time highs, which obviously then suggests that we are going to have an overall bullish bias. If you're not already, please subscribe to our YouTube channel. Come follow us on Twitter, where we're giving out the daily reports with analysis and zones every morning before the market, and then we follow up with daily recap shows to show you what has happened in the market and how we could have taken advantage of those opportunities to further learn and look at the styles of trading that we take. So if you're not already, please come follow us on Twitter, come subscribe to our YouTube channel, and hopefully you can find some really great useful content in there. So as I say, we've been talking about new all-time highs and we had an overall bullish bias, but when we made these new all-time highs, we then got this extremely impulsive move down. As you can see, there's a lot of big red candles, there's hugging the Bollinger Bands, this is a fairly strong trend down into the next zone of support. And then we actually got a really nice false break signal where we pushed through the level, we pushed below the overnight lows, we grabbed the liquidity, we took out the stops, and then we got a nice strong candle back closing above it. Now, this is a trade that I would only suggest for experienced traders. Reason being is because you are fighting the overall trend in the overall trend on the execution time frame. So you're swimming against the tide of the order flow on the execution time frame, and you need to be able to identify that the higher time frame context is supportive. I would not have taken this trade if the higher time frame context was not as strong as it is at the moment. So let's go and take a look at the hourly chart, and I can show you what I mean by that. Okay, so this is the hourly chart, and clearly we're in an uptrend. We've had some strong impulsive moves, corrective moves, strong impulsive move, followed by a corrective move here. And you can see this is a very corrective move after that impulsive move. You have to also understand that all of this price action here was not available to us at the time of the trade that we took. So we had a clearly defined corrective structure. We'd had a clearly defined support level. We'd use it as support here and here, and the overall context of the market is clearly bullish. So that is why we think that this trade was okay to take, is because we're with the overall context of the market. We've got a clearly defined support level, and even though this candle here is a candle which can suggest that there is going to be lower pricing, and we have seen that later, for experienced traders you can take advantage of short-term moves in the market. That doesn't mean to say that this is just going to go down in a straight line. If you get a signal on the execution time frame and you've got the experience to be able to manage the trade, then it's okay to take these trades against the overall trend on the execution time frame, as long as it's with the overall trend on the higher time frame context. But that's something that comes with experience. So let's jump back to the 3-minute chart and show you how we executed and then how we managed the trade, because when you're fighting the overall trend on the execution time frame and you're swimming against the tide of the order flow, you need to be experienced. You need to manage the trade much more aggressively. So let's go and take a look at how we did that. Okay, so back to the 3-minute chart, and again, so we've got the impulsive move, we've got the false break signal, and our entry was at 47 here, and I believe our stop was about 14 points at 33. Yes, it was at 33. So we had a 14-point stop. Now, again, we could go back to the zone, and we did actually end up coming back to the zone up here, but with it being against that big strong move, we just want to take our 1-to-1 and get out of the trade. We want to be aggressive. But even though we're going for 1-to-1, we also want to be aggressive with our management of the trade, because when you see an impulsive move like this, there's also a chance that the market may set up a continuation pattern from the moving averages or around the moving averages or from a previous level of support. So here we had some support on the lower time frame, on this execution time frame, and as you can see, it was just above the moving averages as well. So this sort of area here was where we scaled out of our position, and we actually took some profits. So we actually took some profits when price touched the moving average here. And what we then saw, we saw this move push back down. Now, another thing that you could have done to reduce risk management is if this trade had finished on its lows and then broken down, that would have suggested a continuation pattern, and the bulls weren't necessarily stepping in as strongly as we would need them to be to hit our target. So you could actually reduce your risk by coming out on a continuation pattern there and take a much smaller loss. We actually took half profits and scaled out of the trade to pay for a stop below our entry. So we come out at 53. We had we booked 6 points of profit, and we moved our stop up to 41 because we'd entered at 47. We took half profits at 53, so we was out. We had now had a risk-free trade at 41, and then the market moved on to hit our full target. So, as you can see, another thing that you need to be aware of as well. Let's just delete all of this so we can see. So once we got this impulsive move down, the pushback had been fairly corrective in comparison to the move down. You can see it takes a lot more candles to take out very few bars. So again, this shows that the bulls, when they stepped in, were still not as strong as the bears had been when they pushed this move down. That again is another sign that you want to be aggressive with your risk management and your take profit targets if you're going against that trend. And as you can see, we did just come up and we tested this zone, and then we actually did sell off again. So hopefully this shows that for more experienced traders, you can take trades from against the short-term time frame trend, as long as you've got the experience to identify the right trade locations with the higher time frame context, and you can read the price action in real time, and you have the risk management and trade management skills to be aggressive to manage your risk in real time. So quite a lot of details. This is a bit more of an advanced trade of the week, but I hope you find the content of it useful, and I'll speak to you again next week. Cheers.